Good morning, everyone. You are watching a live daily market outlook for Friday, 11th of January 2013, prepared by Windsor Brokers. The top performer yesterday was none of the instruments, but the guy called Super Mario, the president of the European Central Bank, Mario Draghi, and he said that basically triggered the strong movements in the market on his comments at the press conference following the European Central Bank's decision to keep the rates unchanged at 0.75%, with the strong demand for more risky assets, pushing the single currency to the levels close to the important and the strong 133 barrier, with the other instruments also benefiting, and dollar being pushed significantly lower. As said, the FX markets enjoyed one of those real days for trading. As we said already, the euro and the other risky assets moved significantly higher. The one headline prompting traders to jump aboard the risk-on bandwagon was the decision by the ECB to hold the rates anonymous, those raising any possible speculations that central bank might resume its rate cuts in the near-term future. Mario Draghi also commented that the situation in the Eurozone is still quite bleak, but some signals of a possible recovery, faster recovery than expected, are seen. And according to his comments, possibly that the worst is already behind us, as 2013 is seen as a year for some improvement, and the worst has been seen in the past year in 2012. That brought quite strong optimism into the markets and pushed the currencies and the commodities the levels where they are currently standing. From the other side, overnight price action was triggered, especially that dollar yen broke higher again and reached fresh 2.5 years highs at levels above 89. Were comments from Japanese Prime Minister Shinzo Abe that he made his biggest push yet to make jobs growth part of the Bank of Japan's mandate, as his government approved 117 billion of spending to revive the economy in the biggest stimulus since the financial crisis. Under intense pressure from Abe, the Bank of Japan will likely adopt a 2% inflation target at its meeting that is due at January 21st and 22nd, and rate review. Double its current goal, and consider easing monetary policy again, most likely by increasing government debt, the asset purchases, as it was announced during the Asian session. Japan's current account, which is normally in surplus, swung to a rare and hefty deficit in November, which helped push the yen to 2.5-year low against against the US dollar, and highlighted the need to support the economy as exports weaken. Prime Minister Abe's recipe to jolt Japan from years of deflation and stop-start growth is big fiscal spending and the central bank purchases of government debt, but there are risks, as Japan's debt burden is already the worst among major economies. From today's calendar, we are going to be brief with these things and move into the more interesting items that are the technicals, as we have a lot to say about recent movements, as the most of instruments significantly moved in yesterday's rally. Just to briefly go to today's calendar, the Swiss CPI just released now shows a minus 0.2% decrease on the monthly basis, compared to minus 0.3% in the month of November, and the minus 0.1% of forecast for this release. We're going to put it right now. While the recent releases, Chinese inflation came at 2.5% on the yearly basis in December, much above November's release of 2% and the forecast at 2.3%. That basically put some pressure on the Energy says the crude oil eased from its yesterday's fresh highs at approximately 94.50. Chinese producer price index for December came at minus 1.9%, better than previous release at minus 2.2%, but still above the forecast of minus 1.8%. Japanese economy watchers sentiment for December is showing improvement. 45.8 is the release compared to 40 in November and 41.1 today's forecast. Data that are due to come from Europe and the US come as follows. 9:30 we have UK's manufacturing and industrial production. Both are forecasted in the quite optimistic way. 0.5% is the November's manufacturing production's forecast compared to minus 1.3 in October, and industrial production is seen at 0.8% in November compared to minus 0.8% in the month of October. Great improvement in case, of course, the releases come at around the forecasted levels. And that's all from the European side. America kicks at 13:30 GMT with the US import prices for December improvement by 0.1% according to the forecast compared to November's minus 0.9%, and the US trade balance for November at the same time is forecasted showing a slight decrease in the US trade gap to minus 41.1 billion US dollars compared to the gap of 42.2 billion in the month of October. And Canadian trade balance at the same time for November is forecasted to show the forecast is showing a slight increase in the trading gap to 300 million Canadian dollars compared to the gap of October's 200 million Canadian dollars. And at 1500 GMT, the GDP estimation December's from UK. We have no forecast at this point, but we're going to take a look now and see. Basically, there is no forecast, but previous release was 0.1%. And finally, at late Friday's US trading, federal budget balance from US at 1900 GMT, minus 22.1 billion US dollars is seen the balance gap compared to 172.1 billion in the month of November. And that will be all from the fundamental and the economic indicators. So we're going to move to the technicals that are much more interesting at this morning according to the yesterday's strong movements in the most of the markets. We start with the single currency that was one of the top, if not the top performer yesterday, driven by initially good Spanish auction, better than expected Spanish auction in yesterday's morning session, and then we had the Middle East buyers supporting euro and pushing it higher, and then of course came the European Central Bank and Mr. Super Mario with his comments that pushed the single currency significantly higher. The magnitude of the strength of the rally we can see on the 4-hour chart as the pair nearly fully retraced its recent dip from 133 right up barrier down to 129.96 as the price reached so far 132.80 on approach to 133.00 strong resistance zone. Currently the consolidation is underway. We are within the narrow range of approximately 30 pips consolidation range as the near-term indicators are still in the overbought territory on the hourly chart and pointing lower. That might be triggered for some more significant corrective action with the initial support now seen at 132.47. That's the low of the correction, and pardon, at 132.00 seen as a next good support, psychological support, where ideally any stronger dips should be contained in order to keep the immediate bullish structure in play. And of course we have the previous strong resistance at 131.60 zone. This is the previous range floor. Any extension lower below 132 should in any case be contained at this level in order to not to harm the near-term bulls of 129.96 and the yesterday's low at 130.37 in order to keep immediate focus at tough barrier at 133.00. As said, quite extended conditions on 1 hour and the 4 hour indicators now entering the overbought territory with indicators starting to point lower. Do not rule out some corrective action with the levels seen mentioned previously, expected to contain dips and to keep the immediate bullish structure intact for a possible fresh attack and a possible break above 133.00. That will be signal for resumption of the broader rally from 126.60 low of 13th of November 2012, and that might open extension higher towards levels at 133.80 that marks 2012 April 2012 highs. We can see it on the weekly chart. It's approximately here, this one, and 134.00 as round figure resistance. We have immediate barrier also at 133, just about 133 is the descending 90 days moving average, weekly 90 days moving average, and basically clearance of this congestion at 133.00 is seen as a trigger for a fresh extension of the larger uptrend from 120.42 July 2012 yearly low. Any dip below 131.60 would be again reviving bears and a signal top at current levels and keep the 133.00 out of reach. However, positive technicals and the positive fundamentals that came yesterday that brought quite positive sentiment into the markets see potential for a fresh attack and possible break above a very strong barrier at 133.00 as the most of investors are now in the risk-on mode and the heavy buyers of a single currency. Of course, we will see the current consolidation. If it turns into the corrective action, then we'll be looking for supports at 132.00 and 131.60. Again, warning below 131.60. Downside risk would intensify. For now, the bullish crossover of 20 over 55 days moving averages at 131.30 underpins the current action, with widening Bollingers on the 4-hour chart, seeing potential for some another stronger action of the single currency. The British pound maintains a positive tone following bounce of recent lows at 159.91. This is the low of 2 days ago, as the fresh strength cleared the initial barrier and previous high of 8th of in January at 161.26. Also cleared the to extend the gains to 161.77, nearly 50% of retracement of the down leg from 163.80 down to 159.91, escaping from the dangerous 160 support zone, and now seeing more potential for a stronger corrective action of the latest down leg 163.80 to 160.00. Consolidative action is now underway, as we can see that our indicators are already emerging out of the overbought territory. We might see some corrective easing deeper than the current low that is approximately at 161.40, just ahead of previous high at 161.26. Basically, these levels are seen as ideal reversal point, as the 20 days exponential moving average hourly one so far contained the dips, and these are seen as ideal reversal points for a possible fresh extension higher. However, the reversal of the hourly indicators does not rule out at this point basically the further stretch down towards 161. That should not be exceeded in any case. This also marks 38.2% retracement of the uplift from 159.91 to 161.77, and basically any deeper dips should be contained at or above 161.00 in order to keep the bullish structure in play for a fresh stretch higher. We have 161.85 as a 50% retracement as initial resistance. Then comes 162 round figure resistance, improving hourly studies, but still lacking the momentum, are seeing as destabilizing element at this point. Unless we see the break above 162, according to the daily chart, there is still risk of possible lower top and fresh extension lower. Break above 162 is seen as quite supportive thing, and basically break and the weekly close above these levels could keep the focus at the upside, and for possible test of the recent peaks at 163.00 as initial, and the recent spike high of 2nd of January at 163.80. The positive tone on the 1 4-hour chart is still favoring upside, especially that 4-hour indicators are just above their midlines. With the targets as mentioned 161.85 and 162.00, then we have 162.31, 61.8% retracement, break of which will definitely shift focus completely towards the 163 and the 163.80. However, holding above 161.26, the 161 in case of further reverses will still keep the immediate bullish structure intact. Dollar yen continues its strong rally following a brief consolidative action. As we can see on the 4-hour chart, the bulls are now firmly in play. Corrective consolidative action of 88.40, previous high of 4th of January, that found support at 86.81, and the fresh rally cleared initial 88.40 and the psychological 89.00 level. This was seen during the Asian session, especially acceleration seen during the Asian session, late American in the beginning of Asian session, that hit a fresh high at 89.34, so far surpassing 89.00 and 89.14, our initial upside targets. The overbought conditions on 1 hour and the 4-hour chart, the RSI is just emerging out of the overbought zone, might signal some stronger corrective action down towards 88.40 and 88.00, seen as ideal levels to contain dips and keep immediate bullish structure in play for possible attack higher. On the upside, we have targets at 90.00, and then on the weekly chart it shows 90.39, that marks 76.4% Fibonacci retracement of the down leg from 94-97 peak of 2010 down to 75.56 low of 2011, seen as the next upside targets. However, quite extended the conditions on the daily chart, yet not showing any signals of reversal. Require caution at this point. However, the pair is now mainly driven by fundamentals and comments from the Japanese officials that boosts the dollar against the Japanese yen, but action that is mentioned by Japanese Prime Minister and the Bank of Japan officials could be taken into consideration, as the officials of Japan are trying to somehow contain the recent weakness of Japanese yen, and some corrective action, stronger corrective action cannot be ruled out in the near future. At this point, we are still in the strong bullish mode, and as we said, the ideal supports at 88.40, 88.00, while only break below 86.81 low of 2 days ago would be signal for some more significant easing of the recent strong rally that peaked so far at 89.34. And the dollar Swiss lost ground on the upside rejection at 92.72. This was 2 days ago. Failure to regain the initial barrier at 93.00 created the failure swing, and the break below strong support and base at 92.00 triggered fresh weakness that so far dipped to 91.10, approaching psychological 91.00, and more significant double bottom at 90.80, lows of 20th of December and the 2nd of January 2013, seeing potential for a further stretch lower, according to the negative daily studies that are looking for extension of the broader downtrend from 99.70. Currently, the corrective action on the oversold hourlies, as we can see, the RSI is now above the midline, and all indicators are pointing higher, with fresh momentum being regained on the corrective action from a overnight low at 91.10, facing a good barrier at 92.00, and basically this level is reinforced also by descending a 55 days exponential moving average on the hourly chart, is expected to contain and keep the immediate downside pressure in play for a possible attack at significant supports 91 and then 90.80. Any break above 92.00 would delay immediate bears in favor of some stronger corrective action, and basically will avert immediate downside risk of revisiting a strong support and double bottom at 90.80. As we can see, the downtrend still remains intact, as the main bear trend line currently at approximately 92.70, capped several attempts higher, along with the now again lower moving 55 days moving average, and the 90 days one that is maintaining the recent down move since mid-November 2012, and sideways, still sideways moving 200 days moving average, currently standing at 94.38. Failure to regain 93.00 now sees more pressure towards the downside, and the averts and keeps the upside barriers at 94.30 intact for now, especially after we lost 92 strong support. The previous lows also at 92.14 and the 92.00 recent base, now seeing more potential towards the downside. The crude oil is pausing its recent rally after breaking above the range top congestion top at 93.80, clearing 94.00 and then 94.35, the Fibonacci level seen here on the daily chart. Fibonacci 61.8% of 100 to 72 to 84.05. Setting scope, as we mentioned in yesterday's comments, that bulls are firmly in play and looking for a extension higher, with the more focus now seen towards the upper barriers and the possible stretch towards psychological $100 per barrel now becoming quite realistic, especially in light that some fundamentals are quite supportive, despite disappointing China's data that are again that have again pushed the oil price slightly lower. The reduction of the production of oil from Saudi Arabia by 5% in December is seen as an additional supportive element for the oil price, and sees the recent rally of 84.05 and 85.20 now intact for a possible further extension higher. We have the barriers at 95. I think we have our Fibonacci expansion levels, 95.00. First of all, as we are in the corrective action, 94.68 yesterday's high is the initial barrier, and then 95 round figure, and then 95.33 Fibonacci, 161.8 expansion of the uplift from 85.20 seen as the next upside targets, with the dips so far being contained by 20 days 4-hour chart exponential moving average, and the static support at 92.67 seeing as good support in order to keep the bulls intact. This is reinforced by ascending a 55 days exponential moving average. Basically, the bulls remain in play at this point, with some corrective action expected to be contained somewhere at 92.50, 92.00 in order to keep the bulls intact. Warning, I think, is seen on the 4-hour development of 4-hour bearish divergence of MACD and the RSI. That is seen. We can show it here. That could be warning of some corrective action, stronger corrective action from the technical point of view. Although, as I said, fundamentals are still quite supportive for the oil price, and see more potential towards the upside, unless we lose 92.00 and more significant 91.50, the low of 4th of January, and also close to 200 days moving average currently at 91.23. The focus remains firmly at the upside, and the 95.00 and 95.33 33 is seen as our next upside targets, as the strong rally of higher low at 85.20 stays so far intact, despite the daily indicators are now entering overbought territory. Although some reversal seen on the stochastic could be a signal for some more significant corrective action, yet no firm signal of the market movements, as we are still well above our supports. 93.74 is the current level, well above 92.50 and 92.00 as initial supports. And finally, yellow metal that got pushed lower during the overnight, during the late US and overnight session after hitting a fresh high at 1675. However, overall structure is still positive, as the gold briefly cracked the descending bear trend line. This is the bear trend line of 1752 peak of end of November 2012, with the current easing seen as corrective, as the hourly indicators moved into the overbought territory, with current corrective action being underway. The hourly chart shows a good support at 1665, previous highs 1665 and 1662. This is also reinforced by 55 days exponential moving average, while 4-hour structure sees good support again at this level. Bullish crossover of 20 over 55 days exponential moving averages as seen as ideal reversal point. And if we see the dips being contained at or above these levels, then bullish structure of 1625 low of 4th of January will remain intact for possible renewed attempt higher. If we see break and close above the trend line resistance and yesterday's highs at 1678, that could be good signal for a possible revisit of recent peak at 1694 and 1700 as psychological resistance, with the 4-hour indicators showing enough room for such a move. But again, a larger picture is still showing the gold in the strong downtrend, and basically unless we see the break above 1700, not much is to be expected from the current rally, as risk will remain on the downside, and the risk of a lower top preceding a fresh leg lower could be quite high. Break above 1700, 1690 as 1694 previous high, and 1700 is expected to avert immediate downside risk, and the signal base at 1635, 1625 in order for some stronger recovery. And that's all from my side. I have some questions. Okay, one of our attendees. I don't know whether you want me to answer this publicly or privately, as this goes worldwide. The client was short euro following yesterday's weakness of 1 and 4-hour chart. I agree with you, because early morning outlook in our early morning report was still bearish. Of course, fundamental things that came erased the technicals that we still keep. Personally, I keep it as number one driver, as sooner or later the things come back into the normal track that is defined by technicals. But as I mentioned in the beginning of our session, the first Spanish auction and then a strong demand from Middle East gave initial boost to the euro dollar, and then of course the gains were accelerated by the action of European Central Bank. I think around these levels we had the Spanish auction, and then I think it's better seen on the hourly chart. It was around here approximately at 10-11 in the morning. And of course the stops mounted above 131. I think also I mentioned it in our written analysis and the news. A lot of stops were parked above 131 and 131.38. Of course, triggering the stops has triggered. You can see the acceleration here. Basically, the pair was driven by fundamentals. Now, basically, we are going to see the how realistic was this recent move. If we see the break above 133.00 as quite a strong resistance, failure to break this level will bring us again back to the levels below 132 and approximately 131.38, 131.00 in case of failure. There, I was reading some comments from other analysts this morning, and also they agree that further easing cannot be ruled out at this point. And if we don't see the clear break above 133, we'll be back again to the levels. Unfortunately, you got caught by a rally on the fundamentals, although I mentioned in yesterday's, at the end of yesterday's session to watch the releases and especially the comments from European Central Bank, and mentioned also that widely expected unchanged rate will have a stronger impact on the euro. So I don't know, I don't want to give any advice, but apart from the technicals that we keep as a number one indicator, also we should watch the fundamentals, and I gave the clear warning to everyone to be cautious before release. If you are not sure in the certain conditions and a certain situation, then it's better to stay out of the market until you see the more clear picture. And of course, trading with stops as Bible for us traders is number one thing. If we leave it, personally I got stuck recently with the euro as I just missed to put the stop, and of course the punishment came shortly after that. So if you are not sure about something or you're expecting something, better to stay aside and then see what's the direction, and it's always easier to jump in the market with the trend. And of course, if you are in something that could turn into the negative and dangerous situation, the stops are always there to protect you from stronger losses. Do we have any further questions or comments? Also, I have received an email from one of our attendees. I'm going to answer it privately as it came to my email. I'm going to answer it privately just to remind. I think yes, he's online now, so I will answer it privately. Do we have any further questions for today? It's the end of the week, of course, and again, end of the week you might see some clearing positions, and that could be another not supportive, actually opposite from support for euros. So we can see again a slide below 133. The good scenario would be, of course, a break and close, a weekly close above 133.00. That will confirm the recent rally and give more credibility to the recent rally for a possible further extension. Otherwise, further congestion under 133 and possibly weakness down towards levels 131.26 and 131.00 could be quite likely scenario. Again, I still think that 133 is not going to give way that easy. It seems that we have no questions or comments for today. However, anything that you have, you can also send to my email, that is analysis@windsorbrokersltd.com, and I will be glad to answer any of your requests or suggestions, anything that you think could be improved or changed. And of course, all those that missed any part of the session connected later, you can find the recorded version of this session shortly will be loaded in the YouTube. Our page is called Windsor Brokers Forex. Since we have no questions, we're going to conclude today's session. I would like to thank you all for being with us. As we can see, after the Christmas and New Year holidays, the markets are again gaining pace. I think we're going to see a lot of action in the coming days. I wish you a nice Friday as the last day of the week and ahead of a well-deserved weekend. However, don't forget to take profit, all of you that were long euro it's easy to re-enter market again if it goes long, but if it reverses, then you will regret for not taking profit. Wish you nice and profitable trading, and we are back next Monday at the same time at 8 o'clock GMT, 10 o'clock local Cyprus time. Good luck.